Okay, the balance of risk and reward, isn't it always thus? Let's get more on the markets. We're joined by Sam Stovall, Chief Investment Strategist at CFRA Research. Sam, great to see you. What do you think? Is it greed or fear that's predominant in the market right now?
Well, Andrew, I think right now investors want to recapture some of the greed and benefits from the share price advances that they've had over the past several months. We've had a positive return in September, which normally is not the case in an election year. It was followed by an upward move in October, and I think investors are taking some profits in this 2 weeks ahead of the election. But I think just as it's happened in the past, we will then see a bounce after the election come November and December.
Is that because people will just feel relieved? Well, that's passed and we know who's going to be in the White House and controlling Congress?
Exactly, because when they know who's in charge, they know what the programs are, then they can figure out how to leverage that situation as best as possible and make some profits. So it's typically they sit on their hands when they're not sure who will be in charge. But we think that we could certainly end up with a split Congress. And I think in general, Wall Street will be happy with that.
This is a massive week for earnings. Now, you reckon this week, companies representing more than 40% of the weighting in the S&P consumer discretionary and industrial sector will post their numbers. However, expectations for this group are generally rather pessimistic. The analysts looking for a decline in profits.
That's right. Well, not necessarily because we're seeing a downturn in the economy or anything like that. It's really because the comparisons are quite challenging. The best quarter in all of 2023 was the third quarter. So with the earnings having hit sort of a near-term peak last year, it makes for tougher comparisons this year. Also, what we've seen is that according to S&P Capital IQ consensus estimates, the year-on-year rise was only 3.6% at the beginning of the reporting period, but now it's expected to be only about 2%. Typically, I find that the first week of reported earnings, we tend to see a little bit of a dip before we see improvements as the earnings season progresses. So I would not be surprised if we end up exceeding expectations as we have done in 59 of the last 61 quarters.
Remind us, how is October generally, historically? It's better than September, I know, but is it a good month, generally speaking, for the markets?
Well, for years other than the election year, you're absolutely right that October is better than September. September is the worst by far, whether you're looking at election years or non-election years, posting not only an average decline, but it's the only month to fall more frequently than it advances. October is usually a positive month, except in an election year. So it's September and October that are the bad ones that sort of set us up nicely for an end-of-year rally. But whenever September was positive in an election year, 2/3 of the time we then advanced in October as well, and that led to a running start for the rest of the year.
And we've heard a lot of talk about how market participants, they're not that worried about who sits in the White House. Mr. Trump, of course, is seen as more inflationary with his policies. But one thing that Wall Street doesn't want to see is a party winning the White House and gaining control of Congress.
Well, that's true. The best performance going back to World War II has been a split government. The best has been a Democratic president with a split Congress, but not so bad as a Republican president with a split Congress, mainly because whatever does get through Congress has to be beneficial to both Republicans and Democrats. And usually where that ends up where you don't have a lot of new regulation being applied. So with that, Wall Street and businesses in general can continue to do what they're good at, and that's make money.
That's right. Yeah, that's right. The theory is with the minimizing government intervention in the economy. Sam, leave us with a final thought here. Is it possible to look at the S&P 500 and judge its valuation in historical terms? Does the broad S&P look expensive?
Yes, it does. We just celebrated the second year of this bull market. We had a 34% advance, which was the strongest of all 11 bull markets that celebrated their second birthday since World War II. It was also the most expensive, with a multiple on trailing 12-month earnings of 25. The second highest was at 20, and the average, what we closed at was almost 50% higher than the average for all second-year bull markets since World War II. Third year, average gain is only 2% because 3 of those 11 became new bear markets. 2 additional ones fell, but not enough to become bear markets, and then 3 additional bull markets only posted gains of no more than 6%. So you have 3 that are left over that were worthwhile investing in, but 3 out of 11 is not a very good probability.
Sam, we better leave it there. Thank you very much indeed for joining us. Sam Stovall, Chief